get this great information that we are about to give you all. We have two great speakers that will be able to give you some great information. I have some housekeeping skills, some housekeeping tips that I need for you all to know to keep your mics muted. Um, Hold all your questions until the question and answering session of the program. And the presentation, some of the presentations will be available to you, and one of them will not be available to you. So later on, we will let you know which one will be available to you. We will have something that we will give you at the end if you are interested. I will get ready now to introduce Brenda Maddox, our Family and Consumer Science agent from Marion County. She will be introducing our first speaker.
Hi, good morning, everybody. I have the pleasure of introducing our first speaker, and she is Dr. Joan C. Kuntz. She has a PhD in Consumer Economics and Finance from Ohio State University. In her present position, she is a professor and an extension financial planning specialist with the University of Georgia. Dr. Kuntz has been in teaching and faculty member and research member at the university and for over 17 years. And now in her current position, she advises and supports and trains county agents, family and consumer agents. And so Dr. Kuntz has been doing this for a while. She's given a education and outreach to diverse audiences and in the areas of insurance, risk management, savings and investing, estate planning, taxes and retirement. And she also offers leadership to the Income Tax Assistant Program there at University of Georgia Extension. And so you can see that Dr. Kuntz has an extensive background, but let me tell you what I know for sure. In knowing her, you will not be, you will be entertained, and even more so than that, you will be informed and educated today on the topics that we have for you. So having said that, I am proud to welcome Dr. Joan C. Kuntz to our virtual programming. Dr. Kuntz.
All right. Thank you, everybody, for attending. We really appreciate you being here. I'm going to try to share my screen now. It worked before, so hopefully it will work now. Let's see. Okay. All right. Let me begin. Can everybody see the screen okay? All right, perfect. As she said, my name is Joan Kuntz. I've been at the university for 33 years, but of course I was teaching research for 17 years, but extension is truly my passion. I actually absolutely love people, like educating people, and really just in general, like being around people for the most part. And so this was a great opportunity for me, as well as for you all, to be able to be a part of this webinar today. And I appreciate Fort Valley State University inviting me actually to do this. It's actually a pleasure, and I really like working so much with them and have worked with them over the years in different capacities. Okay, today we are going to be talking about two different tax credits. We are going to talk about first the earned income tax credit, and then I'm going to go into the child tax credit. There has been actually changes, some changes to both of these credits over the past few years, and especially for the tax for 2021 because of the pandemic. And so I feel it's important that I actually cover both these credits. And we have learned over the years that unlike what most people think, everyone who qualifies for the earned income tax credit is not actually receiving that credit. So we feel that it's always important. Every opportunity that we can is to provide information on that as well. Okay, when we're referring to the earned income tax credit, and the child tax credit. Both of these credits are what we call refundable tax credits. There are some tax credits that are non-refundable, or there is a portion of them that is non-refundable. And then you have tax credits that are refundable. Both the earned income tax credit and the child tax credit are refundable tax credits. There has been a change in terms of the child tax credit this year, in terms of how much of that credit can actually be refunded to people this year. And we will talk about that later on when I get to that section. Okay, what is the earned income tax credit? The earned income tax credit is a refundable credit that can give taxpayers a significant refund at tax time, or it can actually lower the taxes that they actually owe. And that's a very important aspect of the earned income tax credit, because of the fact that it was designed to actually help remove people out of the low income status and actually give them income that could help them move them above the poverty level. So that's so important. The main requirement to actually claim the earned income tax credit is that you have to have earned income. And basically what that means is that you just either have to have a job or you have to be self-employed where you have earned income. You can't be an individual who just has investments and you have income from those investments like dividends, interest, and things of that nature, capital gains, because that is not earned income. That is what we call unearned income. So in order to qualify for the earned income tax credit, hence the name, you actually have to have earned income. And that earned income basically can either be from a job or it can actually come from self-employment income. And also individuals must file a tax return to actually claim the earned income tax credit. Okay, here are some EITC facts. Oops, sorry about that. Now my problem is going to be getting back to that slide. Let's see. Let's see here. This thing is very, very sensitive. Oops, I'm going forward instead of backwards. I may have to end it and then start back over. Sorry about that. I apologize. Okay, so let me pull it back up again. Okay. Okay.
As Dr. Kuntz get her slides back up, let's just remind you all that if you have questions, go ahead and type those in the chat box.
Okay. All right, we should be okay now. I apologize for that. This mouse is actually very sensitive here. Okay, all right, some EITC facts that I wanted to cover is the credit can eliminate any federal tax that you owe at tax time, so that if you owe any money at tax time, then basically that credit can actually take away that tax. If that earned income tax credit amount is more than what you actually owe, then you actually receive money back in terms of a refund. And so, but even if you don't owe any taxes at all or any during tax, once you file your tax return, you can still actually receive that money back as a refund. And that's one of the great things about the earned income tax credit. You can actually claim that credit whether you are single or married, or whether or not you have children or not. When the earned income tax credit first started, only those people who had children qualified for the credit. But now over the past several years, I mean, people without children can also qualify to receive the credit. The credit amount that a person actually receives is actually going to depend on several things. It's going to depend on their income. It also depends on their marital status, and it also depends on their family size. Of course, the lower your income is, there's a set income that where if you're at the bottom, then that credit is going to be small. And then the income, as your income increases to a certain level, then the amount of that credit you receive is going to increase. But then it actually caps off at a certain point, because they don't want to give the credit to people with such a high income. So once it reaches your income reaches a certain level, then at that point, then the credit begins to go back down until it actually phases completely out. And those people who are above a certain income cannot receive it at all. Those who are married, as with most tax benefits, will typically receive a higher credit. And those who actually have more children will also receive a higher credit as well. Families with more children are, as I said, are eligible for more credit amounts. And basically the credit amount rises with earned income until it reaches that maximum amount, and then it's going to gradually phase out. But in 2021, the credit is actually worth up to $6,728. So a person basically can almost get $7,000 total from the earned income tax credit, which in my opinion is not a small amount of money. Okay, some 2021 changes to the actual credit. Those things are actually important. And this is, these changes only apply to those people who do not have children. The maximum benefit actually increased from $543 to $1,502, almost tripled for those people who did not have children. So prior to 2021, of course, the maximum that a person without children could receive from the earned income tax credit was $543. But because of the 2021 changes, the maximum a person could receive who does not have children is actually $1,502. The income level at which the credit is maximized also increased for 2021. For example, once you reach the income of $7,100 in prior years, the amount of that credit would start to decrease. But now that amount has actually been increased to $9,820. So a person who does not have children, they can actually earn up to $9,820 for the maximum amount of that credit. And then at that point, once the income gets higher, then the amount of the credit will actually decrease. Also, another change that took place in 2021 is that the minimum age that you could receive the credit actually decreased. It used to be 25 and now it's actually 19. But that only applies to those people who are not full-time students. The reason the age was at 25 previously is because they really wanted to avoid full-time students being able to qualify for the earned income tax credit, because full-time students basically are going to school, and that's really the reason that their income is actually lower. So they wanted to eliminate those people, those students who were in college. But now basically decreased the age at which you can actually receive the credit down to 19. But within the requirements that it specifies that you cannot be a full-time student. So you can have someone who just graduated from high school, who did not go to college. Maybe they're working at a fast food place. They could be working anywhere, but they may qualify for the credit now, when in the past they did not qualify for the credit. And so that actually incorporated quite a few people this year. And so there are some people who may not have even filed their tax returns this year, maybe thinking that there was no point in them filing, but these people probably should have filed, and they can still file if they choose to do so. Now, one of the things I do want to point out is that these changes are applicable to 2021 only. And there have been quite a few changes only for 2021 because of the pandemic. We don't know for certain whether these changes will continue or whether or not they will stop. But as of now, they are for 2021 only. we do know that in the past, changes have been made and they were supposed to be for one specific year, but then later on, they decided to keep those changes. Okay, let's see. Okay, some additional information about the 2021 changes to the earned income tax credit is that this year, because of differences in income, there was a, you used to have to base the earned income tax credit on what your income was in that tax year. But for this particular year, 2021, taxpayers were allowed to use their 2019 earned income if that income was higher than their 2020 income to qualify them for the earned income tax credit. And if it would give them a higher earned income tax credit payment. So basically, when we did taxes this year, we could decide based on that person's income if they use their 2019 income or if they use their 2020 income. And we use that income that would give them the higher credit amount. And so that was a really good change that was made for many people because income levels actually did change for many people in 2020 because of the pandemic. And so as a result, their incomes may have been lower. And so they would have received a lower earned income tax credit than they would have if they had used their 2019 income. Now, that's a temporary change for 2021 as of now, but a permanent change that has actually been made to the earned income tax credit is the fact that in the past, if you had investment income, meaning that if you had stocks, bonds, mutual funds, any types of investments where you received investment income, you actually were disqualified from receiving the earned income tax credit if you had $3,600 in investment income. This change actually indicates that you can have investment income up to $10,000 now and still qualify for the earned income tax credit. So those people who are not making as much income as some other individuals, they can have investments, but now they can earn up to $10,000 in their investments, but they can still qualify for the earned income tax credit as long as their investment income does not exceed $10,000. And in the past, that amount was actually $3,600. So that is actually a really good change as well. And this chart you may not be able to see as well, but it actually is just a chart that lets you see how when when determining whether or not a person actually qualifies for the earned income tax credit and how much, you can basically see that when their income is actually very low, they qualify for a lower amount of the credit. But for each category, whether they have 3 children, 2 children, 1 child, no children, or no children based on the prior law, you can see that when they first start out, the lower their income is, then the lower the credit amount they're going to actually receive in terms of the earned income tax credit. But as their income goes up, you can see that credit amount can max out for those who are actually merited $6,728. And then it stays that way until their income starts to get so high, then the credit amount that they can receive begins to go down until it goes all the way back down to 0 when their income gets so high. So this is just a chart that actually shows that information. And if you are interested or you think you may know someone who may qualify for the earned income tax credit and did not actually file their tax return, you can actually go to this particular website. You can click on this link and you can take a simple quiz, or they can take a simple quiz to see if they qualify. If they qualify, they can still actually complete a tax return to actually receive their earned income tax credit. Because this is not like the child tax credit. It's not going to come to you automatically like they're doing with the child tax credit this year. With this earned income tax credit, the person has to file the tax return to actually receive it. So if you think you qualify, or if you think some others that you know may qualify and did not file a tax return, then they can go to this website and take this quiz, and they can still file a tax return to receive the earned income tax credit. Now let's talk about the child tax credit. The child tax credit basically is a credit that is worth up to $2,000 per child. Also, the child must be under the age of 17 years old. Only $1,400 of that credit is actually refundable in normal tax year. The child must live with you for more than half of the year, and you must have earned at least $2,500 in earned income. So basically, this is what the criteria is for the child tax credit in general. This is how it's always been. This is what we've used. This is the criteria that's in the tax software when we actually create these returns. However, there were some changes actually made for 2021 only, and those are the things we're going to talk about here on the next slide. For 2021, there were several changes that were made. The credit now, instead of just being worth $2,000, the credit for 2021 is worth up to $3,000 per child. However, that amount actually is up to $3,600 for a child, for children under the age of 6. So if the child is under the age of 6, the credit amount is worth $3,600 per child. But if the child is actually 6 up to 17, then the credit amount is actually $3,000. And this is a fully refundable credit, whereas in the past, only a portion of the credit was refundable. For 2021, and it only applies currently just to 2021, the entire amount of that credit is actually refundable. To qualify for advanced payments, the government decided, because of the pandemic, that they wanted to allow people to actually receive a portion of their child tax credit in advanced payments. I don't know how many of you have been around as long as I have, but there used to be advanced earned income tax credit payments, but that was actually stopped some years ago. And there was a reason for that. I won't get into that right now, but those reasons were important, the reason they stopped the advanced payments. But this year for the child tax credit, and this is for 2021 only, the IRS is allowing people to receive a portion of that credit before tax time. Normally you have to just do the credit on your tax return, and then you actually will either receive a reduce your liability, or you will receive a refund. To qualify for the actual child tax credit, you must have claimed the child tax credit either on your 2019 or your 2020 tax return. If you did not do that, you must have provided the IRS with your information in 2020 to receive the economic impact payment, or stimulus payment as some people refer to it, using that non-filers tool on the IRS's website. If you did not do either one of those, let's say you're not required to file a 2020 tax return, if you have not completed that non-filers tool on the IRS's website, then you will need to go to the IRS's website and complete the non-filers tool if neither of those two things actually apply to you. In order to qualify for the actual credit, you must have lived in the US for more than half of the taxed year. So basically you have to have lived here for more than half. That means more than a 6-month period of time. So you must have an adjusted gross income. If you are a single individual, you must have an adjusted gross income of $75,000 or less. If you basically are head of household, you must have an adjusted gross income of $112,500 or less. If you are married filing jointly, then you must have an adjusted gross income of $150,000 or less. Also, to qualify for the advance payments, you must have a qualifying child that is age 17 or under at the end of 2021, and that child must have a Social Security number. Now, some people will oftentimes ask, okay, well, what is a qualifying child? A qualifying child has to actually pass certain tests according to the IRS. To be a qualifying child, there has to be a relationship. They have to be a certain age. There's a residency requirement. And then there are two other requirements on the next slide that we will get to. The relationship, as you can see, can be a variety of different relationships. The child has to be your child, your grandchild. It can be a stepchild. Of course, the child can be adopted, but also it can be like a sibling or a step sibling. It can be a half sibling or any descendant of those. And it also can be a foster child if that child was placed into your home by a government agency. So those are the different requirements for relationship. When it comes to age, as I mentioned, the child must be 17 years old or under on December the 31st, 2021. Now, when it comes to residency, there is a requirement that the child must live with you in the United States for more than half of the tax year. That child must live in your home for more than half of the tax year. And it's okay if that period of time is not a consecutive period of time throughout the tax year. That is okay that is the case, but it has to at least add up to more than 6 months. It doesn't have to all be consecutive. So I have a note here that comes from the IRS website, which people oftentimes need to understand that there is an exception for a non-custodial parent when it comes to this situation. Because of course, with the non-custodial parent, the child does not live with you. So if you are a non-custodial parent and you want to claim the child tax credit, you have to actually, you can be permitted to do so, but the custodial parent has to actually fill out form 8332, giving you actual permission to actually do that. And there is a form on the IRS's website where this can actually be done. So you can be a non-custodial parent and then qualify, but the residency requirement for custodial parents is the child must have lived with you for more than 6 months of the tax year, for more than half, which is 6 months. But if a non-custodial parent is going to be claiming the credit, then that custodial parent has to fill out this form and actually sign this form, giving that non-custodial parent permission. Also, the child must have a valid Social Security number. Now, when it comes to the parents can have a taxpayer identification number. However, the child must have a valid Social Security number. And also, the child must be considered a dependent for tax filing purposes. So that is what it means to actually be a qualifying child. You have that relationship requirement, you have that age requirement, you have that residency requirement in terms of how long the child should stay in your home if you are a custodial parent, and also if you're not a non-custodial parent, what has to happen. The child has to have a Social Security number, and then there also has to be, the child has to actually be your dependent. Now, when it comes to the advance payments will actually start initially. When it comes to these tax changes, oftentimes you start out with one thing and it ends up something else. That's what happened with the economic stimulus payment. And that's not the IRS's fault. That's really nobody's fault, because things are evolving. When these laws are being made, and they're being made very quickly to try to get money out to the actual taxpayers, then sometimes changes have to be made. Originally, it started where payments were going to start July the 1st. However, that has now changed to July 15th. And of course, you may even get payments later than that. May start for some people later than that. because just like with the economic stimulus payment, but it's not just going to be, okay, July the 15th, everybody who qualifies for this advance payment is going to immediately get them, because it's an actual process. But when those payments will start. Half of the credit will be issued periodically in equal amounts by the IRS through the end of 2021. And then the remaining half of the credit that's not paid in advance will be received when filing the 2021 tax return. Now, what's important to keep in mind is that the amount that the taxpayer receives at tax time will be reduced. So your child tax credit payment is going to be reduced by the total amount of the advance payments that you actually received. So if you received half of those payments already, when tax time comes, you're not going to get a full amount. You're going to receive the other half, which it could have an impact on how much you owe in taxes if you owe taxes on your tax return. So that is something to actually keep in mind. There is going to be what's called a safe harbor rule that actually will protect some taxpayers from needing to pay back money that's received in error, meaning if they receive some advance payments in error, there's going to be a safe harbor rule. I don't know the specifics of what that's going to be and who will be qualifying for that. So it is real important to make sure that you are only receiving what it is you are supposed to receive, because there are no guarantees that you may not have to pay money back if you have it in error. However, there are supposed to be some rules set in place to prevent, payments that were paid erroneously from having to be repaid. But I don't know the specifics of that yet at this time. Some important website links that I have here, and if you have your phone, you might want to take a picture of some of these. From the IRS, you can go to their website. They have a tool where non-filers can submit their information. So if they did not file a tax return, they have not already filled out the non-filers tool to get their economic impact payment, then they can go in and put their information so that they can receive the child tax credit payment. You can also get frequently asked question answers on this page. And also, you can go to the IRS's website to view your eligibility. You can review what advance payments you have received, because you're going to have to create an account. I wanted to actually go in and then go through the process myself. However, because I do not qualify to receive a child tax credit payment, I don't have any children that meet that requirement. So I could not go through the actual process myself, but I did get far enough into the process to realize that I think an account has to be created. So you will be able to view your advance payments. You will also be able to unenroll from getting advance payments. And some people will choose to do that because they don't want to get it. They want to get all of their payments at once they file their tax return, or they don't want to take the chance of getting a part of the payments, and then come tax time, they ended up owing more taxes than they thought because they had additional income. And now those payments that they received earlier could have offset those taxes. So everybody can make that decision for themselves in terms of unenrolling from getting the payments or not. You don't have to get the payments, but you will automatically get the payments unless you unenroll. If you have filed a tax return and you have claimed the credit previously, then you're going to automatically get the payments unless you unenroll. So that's important to take into consideration, but you can unenroll. You have to opt out, not opt in. And then there's another site on the Center on Budget and Policy Priorities website where it has instructions on how you fill out the IRS non-filer form that I thought may be helpful for some people, because some people do struggle with filling out some forms. So that is also a website that may be helpful. Now, I can never do a presentation without fully talking about taking full advantage of a tax refund, because for me, when we're even doing volunteer income tax assistance for taxpayers, one of the most important things for me is to try to encourage these taxpayers to actually at least save a portion and put away some of the money that they have for a rainy day. I always tell people it's never a matter of if there will be a rainy day. It's a matter of when that rainy day is going to come. And that is true for all of us, regardless of income. And I think it's even more important for those people who are within certain income brackets. So I always have to end my presentation by discussing or talking about the importance of doing that. When I talk about take advantage of your refund, there are three things that I think about primarily. And one is always saving for an emergency fund. And that's that rainy day fund. I always recommend that anytime you're getting additional money, this is just my own philosophy, because we were always taught that you save at least 10%. But my philosophy is that basically when you're receiving money that you don't expect to receive, my opinion is that you should save at least half of that money. And if you choose not to save half, at least save a portion of it as much as you possibly can, because that money may, that was not money that you expected. You were not going to have it. And of course, you may need that money in the future when something actually comes up, and you may need it sooner versus later. You also may, I recommend to people that if they have high interest debt, unlike some of these people who believe in all these folks that promote debt is a bad thing, I don't necessarily look at debt as a bad thing in general. I look at certain types of debt as a bad thing in general. I think when you incur in debt to actually to get a mortgage for a home, or if you need to buy a vehicle so that you can get back and forth to work, those are reasons to actually get into debt if necessary. But if you have high interest debt from credit cards and personal loans, I always recommend that people try to pay those things off as quickly as possible, because the amount of money that you're paying on high interest debt is really a waste of money, because those interest rates are so high. So I always recommend high interest debt be paid off if at all possible. And then also use for your goals. Refunds can be used for goals. And I have people tell me all the time, well, you can't save when you don't have any money. And see, I just beg to differ. My parents always taught me differently. My mom, when we were growing up as children, and I am the ninth of 10 children in my family. And one of the things, there were two things that we had to do when we received money. Number one was we had to put 10% of that money in church. So I never figured out when I got that quarter how to put in 2.5 cents. But we had to put in like 10%. So we always had to put in 3 cents. Sometimes I would kind of cheat and put in 2 instead of 3. But my mama never found out. In any case, though, she always taught us that. And then the second thing was we had to save a portion of our money. My mom made us all piggy banks. We couldn't afford the nice piggy banks, but we had mason jars. And basically in those jars, my mom put holes at in the top of the lid. And every time we received money, we had to give a portion to the church, and we had to save a portion. And I guarantee you, when I went to graduate school, that's what saved me, because my mom taught me those values. And so regardless of how much money you have, you can always save towards your goals. Now, your goals may not be the same as another person's goals. My goal in grad school was to make sure that I could pay my rent and I could feed myself and my son. And every time when I was struggling, I would always go back to my piggy bank, and I would have enough money to be able to buy something to eat until I could get my next paycheck. So I always think it's important to have goals. And these are just some examples of 3 goals, typical goals that people actually have. And so I recommend that whatever it is, it could be something a lot smaller than this, but you always try to set aside something for your goals. Now, a couple of other things that I wanted to mention before I open it up for questions is quick tax tips. And there's 2 major ones that I find to be very, very important when we're doing volunteer income tax assistance. And the first one is this: merit filing jointly. This may seem a little random, but it's really not. Merit filing jointly typically allows for a much more preferential tax treatment than merit filing separately. And this is so important because we have oftentimes have people come in to our volunteer income tax assistance sites, and they want to file merit filing separately. And for the life of me, in most of the situations, it is not the best thing to do. And the reason this is so important is because it goes back to those credits that we just discussed. When it comes to earned income tax credit and child tax credits, you cannot qualify for these credits if you file merit filing separately. That is the only filing status where you cannot qualify for these credits. So it is so important to, and it's not just that, I'm bringing it up related to the credits, but it's so important for other reasons as well. It will usually put you in a much better tax bracket. You will be able to have a higher income level and lower taxes as a result. But you will also qualify for things that you will not qualify for if you are merit filing separately. It has a huge impact on the deduction that you can take on your tax return. You know, if your spouse wanted to do itemized deductions, then it will force you to actually do itemized deductions. One take the standard, you know, so it has a huge impact on tax returns, but it has a huge impact on your ability to be able to qualify for credits. Another thing that's so important is to look at your pay stubs and make sure that you are withholding enough money. I mean, every year when we're doing taxes, people can't quite comprehend that if you don't pay any taxes during the tax year, when your tax return is completed, chances are you're going to owe the government some money. So it is so important that people be able to go in, fill out a W-4 form with their employer, and be able to have the right number of exemptions so that they will have the proper withholdings from their tax return, so that come tax time, they're not owing large sums of money. And also, if they are receiving child tax credits or any other types of refundable credits, then they will be able to receive those credits back during tax time. And that's what most of the people are looking for. So these are two very important things that I always try to point out, because they do have an impact on the credit amount that the person is actually going to receive, or if they will even qualify for the credit at all. And that is it. And so I will go ahead and now open it up for questions. I think we finished a little bit early. Yep.
We did. And before we get ready for questions with Ginger and Terrellyn, I wanted to say Facebook Live is going on. I forgot to say it in my welcome, but we have 3 Facebook Live pages going on: Crawford County, Swiss County, and our College of Ag, Fort Valley State College of Ag page is live too. So now we will go ahead and do our questions in the chat box, starting out with Ginger and Terrellyn. You all can go ahead and go ahead with your questions.
Okay, I have one that came in. What if you,
Go ahead.
Did you say Ginger? I'm sorry.
You fine, Terrellyn?
Okay, what if you did not file either way?
If you did not file either way, what do you mean either way? I'm not sure I understand.
Okay.
Not sure what either way means. Yeah.
Okay, let's see who sent that question. Maybe you need to reword it, and we'll go to the next one and come back to that one. Okay.
That sounds good.
Okay, is merit filing separate better for blended families?
I don't think merit, sometimes people will file merit filing separately because they think about certain liability issues when it comes to things like child support or past taxes owed, but the government allows people who file merit filing jointly to be able to fill out forms to not be responsible for the other spouse's liability. So no, I do not think merit filing separately is better for blended families, because when you think about it from a financial aspect, it's always financial. It's better financially to file merit filing jointly.
Okay, Ginger, I don't want to do them all, but okay, here we go. I don't want to be like I'm taking over. If you file married but separate, but head of household, can you get the tax credit?
If you file, say that again.
If you file married, but you're separated maybe, but head of household, can you get the tax credit?
Yes, I think what the person is asking is you can be a married person, and if you are legally separated from your spouse for more than half of the tax year, you can file head of household if you meet those qualifications. You have children in the household, and yes, you do qualify to receive the credits.
Okay, are we ready to go back to the other question? What if you did not file either way?
Yeah.
The participant, would you like to expound on that question, please?
Is it me? I'm wondering if they mean that they didn't file either way, married filing jointly or married filing separately, but I'm not sure if that's what they're asking.
Okay, let's see. Ginger, do you see it? Can a person file for the child tax credit themselves, or will they need to go to a tax preparer?
They don't have, well, actually, to qualify for the credit, they don't have to do anything if they've already filed either their 2019 or 2020 tax return. If they have not filed it and they need to file it, they can still go and file their tax return to do it. If they did not file a tax return and they don't plan to file a tax return, if they filled out the non-filers form to get the economic impact payment, then they're already in the system. Those are the two ways they're already in the system. So they will automatically receive it unless they unenroll. Now, if they did not do either of those, then they will need to go on the website and fill out a non-filers too. They don't have to do the tax return. Does that answer the question? I hope so.
I hope so too. Well, I have one.
Okay.
And it may seem funny, but for a person like me with no children,
Mm-hmm.
And I heard you say something earlier about a certain amount if you didn't have children. Can you talk about that a little more?
Oh, the earned income tax credit. Yeah, you can qualify for the earned income tax credit if you don't have children. The income limit is actually really low though. The income limit, I think I had it in one of those slides. Is it 19,000? It may be 20. I can't remember. The income limit is really low if you don't have children, because the earned income tax credit is literally designed to move people above the poverty level. And so that's how they determine at what income levels they will cap it. So okay. Yeah, to qualify, you have to have a low income, and that income is typically really low.
Someone asked for a copy of the PowerPoint presentation. Will there be a copy of the PowerPoint presentation provided?
No, the PowerPoint presentation will not be provided to the actual participants. The PowerPoint presentation will be provided, for you all at Fort Valley State as educators, it will be provided to my fax agents as educators, but I won't be providing it to the participants.
There is a link in the chat box that Brenda Maddox put for Facebook.com FVSU videos. You can go back and look at that, and you'll have a copy of the PowerPoint that way.
Yeah, you can go back and watch the PowerPoint over and over there, can't you? Yeah.
Yes, ma'am.
That's what I was thinking.
Millicent, I think that's all of our questions. I hope we got them all.
Okay, well, if that's all the questions for this particular portion, we will move on down to the introduction of our next speaker, which will be done by Philip Petway, our Fort Valley State Extension 4-H agent out of Twiggs County.
Thank you, Millicent. Can everyone hear me?
Yes.
Okay, thank you. Our next speaker would be Mr. Sherwin Riley of LESWIN Financial, LLC. He's a strong advocate of personal finance as a certified financial education instructor. He has taught and coached in financial sector for over 10 years now. He graduated from Troy University with a bachelor's degree in business and finance and a master's degree in management. He earned a second master's in public administration from DeVry University. He has served 4 years in the Air Force, followed by a short career with the Department of Defense. Sharon is a member of Alpha Phi Alpha Fraternity Incorporated, where he serves on several financial organizations throughout Broward County in the Fort Lauderdale area. He serves as a board member and deacon of Christian Life Center Church. Sharon believes in teaching financial literacy not only to adults, but to youth as well. He supports organizations like Junior Achievement, Young Investors Society Club, Stock Market Exchange. He and his wife, who also is a certified public accountant, have already begun instilling these values in their 3 young boys that they have. I've known Sherman since, I'm not telling my age, since I early career in Live Oak, Florida, when he was a senior in high school. He has a twin brother, and it's my pleasure right now to bring him on to talk to you about some financial planning. Sherman.
All right, Brother Petway, I want to thank you for that nice introduction. And also, too, I want to give kudos to Dr. Koontz for well-informed education on the earned income tax credit and the child tax credit. Now, I would definitely like to share my slides as well. There we go. All right, so let me just pull up my slides here and then we will get started. But I want to salute everyone that's on this particular webinar today to gain this valuable information that's available here that you will garner. So again, my name is Sherwin Riley. I'm a certified financial educator. I'm the founder and CEO of LESWIN Financial. And so I just have a passion for just teaching financial literacy, because it's one of the aspects of when we go through our elementary years, high school years, and even oftentimes when we go to college, financial literacy is really not taught in those particular platforms. And so oftentimes we get our experiences in life when we're buying a house or maybe when we're filing taxes, as far as that financial literacy that we probably could have garnered early in life. And taking advantage of these opportunities is always best. And that's why I'm so passionate about teaching it to the youth, because if they could take advantage of these opportunities early in life, then we could be further advanced of where we're currently at and not be able to make some of the same mistakes that we've made at our ages now, but being able to capitalize that with more time into place. And so here, as Brother Petway mentioned, I'm a certified financial educator. And so we just educate. We educate along the lines of budgeting. We educate along the lines of getting you out of debt, putting you in a debt management program. And one of our premier services is investing. Investing in regards to whether it's for general purpose, for college, retirement, short term. We're always big believers of putting your dollars to work, using your dollars as soldiers, as army, going out to work for you. And we talk about some of those employees, right? Hiring your employees, which is your dollars, which is the dead presidents. And oftentimes our bad dollars, the ones that's not working for us, that's lazy, is the dollars that actually keeps us in debt. And the ones that's actually working for us is what actually gets our money going. And so with Dr. Koontz, is the information that she's provided today, we're going to talk about the extension next. What do you do now that you're in receipt of these particular dollars? How do we further plan to execute it back into our households to where we can further continue to grow financially and put ourselves out of some of the holes of what we're currently in? That's the intent of the federal government when they're actually giving this additional money out, especially during the pandemic when so many households suffered. We need to be able to capitalize on these opportunities and not look back and wonder, where did these resources go at? So one of the main things or principles that I always like teaching is get your soul right. Money does not grow on trees, where many times our kids think that money grows on trees, but it really grows from the seeds that we plant. And the key to this is knowing the fact that once we plant our seeds, we can't just not plant the seed. In order for that seed to grow, we must water it in order for that seed to grow. And so oftentimes that's what the financial literacy comes into place. Once we get this information today, we need to execute. We need to water that seed in order to grow. And so organized finances is the soul for the growth in itself. Now, I'm going to cover three aspects today. We're going to cover the budgeting, we're going to cover debt management, and then we're going to cover investing. And now, I would tell you the majority of my presentation will not be on PowerPoint slides. I'm a firm believer in showing you execution how things pretty much works when we're actively talking about finances, because finances, we want results. And so when we start about and we look into our finances, the main thing, the foundation of everything that we do when it comes to finances, Dr. Kuntz mentioned this during her presentation, is the foundation is the budgeting. When you look at your house that you currently live in, we oftentimes forget about the foundation, but the foundation is the most important piece. It's that slab that's laid that we're currently sitting on. If we don't have that foundation, then we don't have the house. If we don't have the budget within our finances, we are being misled, and it's where probably 60% of people in America now that does not have a budget. They don't know how to tell their dollars where to go. So I'll provide it here, this Excel spread, this PowerPoint slide here with some examples here of different ways that you can utilize a budget. One way is through online budgeting, where you can have real-time access through mint.com. Dave Ramsey is a big proponent of financial teaching. He has an app and a program called Every Dollar. Many of you probably use a good old Excel spreadsheet, and we'll look at that here in a moment, some of the ones that I currently use. And with the budget, we're always looking at a zero-based budget. What is a zero-based budget? By the time that you determine your monthly income and the time that you determine your monthly expenses, at the end of your budget, that number should be zero, because you should be able to tell every single dollar that comes into your household each month where those dollars to go. Oftentimes what happens is we normally have, if we do have a budget, we have a miscellaneous expense. And when we have a miscellaneous expense, that could go to say, hey, look, I'm going to spend that. And that miscellaneous expense is not necessarily tied to a certain category, and we get ourselves in trouble. So let's just kind of go through this here a little bit as far as some applications, and let's discuss as far as with the budget in itself. So the first one that we looked at was mint.com in itself. So how does mint.com works? So mint.com you can have here on a website, or you can also use it here for an app as well. Now, when we look at this here, we want to look at as far as your monthly income and your monthly expenses. So also too, this tracks your credit cards, investments, property, and loans. Let me go here. And I want to show you practically just kind of sort of some of the actual techniques as far as that what mint.com has. So when you go here and you create your budget, the first thing that you want to establish is your income. Looking at your monthly income and how much income that you're actually bringing in. You also too, once your income is developed and set, you want to determine your actual monthly spending. And like I say, this is actually real time. So every time that you swipe your card, this is going further left once you actually set your actual budget. Now, if you want to add any other income, whether that may be Social Security, whether we have retired military, where you have a retirement check, or any other supplemental income outside of your regular income, you're able to provide this here. Now, within your spending, you set certain categories. Your rent, your mortgage, auto, bills and utilities, groceries. You can all do that here through mint.com and being able to establish this here. So again, I mentioned this is actually real time. And the one neat thing that I like about Mint is you're able to categorize it. So when you have your transactions as real time, so you can see descriptions, Target, Shell, 24-hour fitness. Every time you're swiping, when you see the category here, you can categorize it accordingly. Now, you can also split transactions as well. So when we talk about split transactions, what does that mean? When we go to places like Walmart, or we go to like these Target or BJ's grocery store, oftentimes you can do shopping and you can also do groceries. but having accessibility to be able to split, to be able to still keep your budget in accordance to your categorization, you're able to do that with Mint and to be able to split out these various transactions. So Mint, we like that. It's a very good tool. Also too, as I mentioned, it has your credit cards so where you can keep up with your credit card payments. Also too, you can add your investment accounts here. And then also too, it has bill payment tracking. So oftentimes when we may be getting this additional money for the child tax credit or the earned income tax, we can use these allocations towards paying our bills and being able to track it accordingly. Now, we also looked at, as I mentioned, another app that you can use, and also it's a website. It's called Every Dollar. And Every Dollar works similar to Mint.com, to where you go in here and you put in your income, you put in your expenses, and you're able to track that accordingly. Now, the good thing about Mint.com and Every Dollar is they're both apps, they're free. So you can go through it online or you can develop the apps as well. And these two applications are free in itself, okay? Now, we also looked at, as far as we talked about, was an Excel spreadsheet. Well, oftentimes that could just be the old school way of just setting your budget. Now, one of the things that we like to establish in these particular Excel spreadsheets is determining your monthly income, determine your monthly expenses, and then being able to allocate a percentage of income spent. So you can look at your total monthly savings, your cash balances, and what we've done is we've created different itemized different expenses to where you could put in a date, you could put in a certain amount, you could put in your income source, and then we're able to matriculate every single month when we're going through that particular budget and watch or actually budget accordingly. So these are various ways that where we can budget, and it's always important you determine when you get this additional money, we need to start planning now how we're going to be able to get ourselves in a better position than where we're currently at, whether that's through budgeting or whether that's paying off debt. And that's the next aspect that we're going to talk about. And when we talk about debt, that's a very important thing here. Now, as I mentioned here, getting into debt takes about 20 minutes because when we go to the mall and when we sign up for that store credit card, it literally takes 20 minutes. And then oftentimes getting out takes 20 years because we're constantly paying minimal payments on that particular debt. And that interest rate on that debt is continuously increasing every month, compounding on an annual basis. So the one thing that we want to get out of is living inside of a rat race and chasing the cheese, and being able to have that financial freedom to afford us the opportunity to go on vacations maybe anytime we want, or to maybe retire at a certain age other than 62 or 65, or whenever the federal government determines when you can have access to your retirement. Because if the less or the least debt that you have, that's the more financial freedom that you can create for you and your family. Now, I'm a big believer, and Proverbs 22:7 says, the borrower is the slave to the lender. As long as we continue to borrow in a bad way, and we have credit or debt working against us, we're going to forever be the slave in the situation. And as we just celebrated June 10th as far as slavery, right? We still live in current slavery today, because if your money is telling you what to do, you're in slavery with your money. And so that's one way that we need to be able to execute, plant seeds and water it by using this additional resources that's going to come and get ourselves out of this situation. Now let's talk about this here. So when we look at getting out of debt, what does that actually look like? So we actually cover a certain program here to where we look at getting people out of debt. Now here's a great example of getting out of debt and how this can actually help you. So I have created an account here, a little demo account, and we have a situation here where someone has a balance, a credit balance of $7,090. And in particular, they have two different type of accounts. They have, in this situation, is two credit cards. You got a Missouri Credit Union, you got an FSU Credit Union. And so when we look at these particular debt programs, right, you'll look at the balance on this is about $2,500. The highest balance or the credit limit is $5,000. The monthly payment is $200. But look at this, the interest per month is 16.9. look at the monthly interest that they're paying, $35.40. If we go and we actually look at the other account, let's look at that as well. Now on this here, we can add as many accounts as we want. We can add our student loans, we can add our car notes. But for this practical scenario, this is just credit cards. You'll see here balance 4,500, credit limit 4,500 here. So here's where we go and we look at this. So, right, how do we actually determine to get out of debt? Now, what happens is on the $7,000 balance, if you look at this total debt budget per month, in this particular case, it's $250 that you're paying towards these two cards. And what happens is you go down here, you look at your debt payoff plan. You can get in what we call, whether it's the debt snowball, that's paying off your lowest balance first, or you can go through the debt avalanche where you actually pay your highest interest first. There are several other different ways that you could choose to also pay off the debt, but one of the most common and popular ways to pay off debt is through the debt snowball. So basically what happens is in this particular plan, you look at your $250 per month, and let's say, for instance, we take our debt snowball. In these particular accounts, if we're paying, let's say, for instance, $250 per month on these cards here, here's where our credit card will actually be paid off. Our first credit card will be paid off here in August 2022. Our next credit card now will be paid off in June 2024. But let's talk about this here. So we now get this child tax credit. Let's say, for instance, we have a family of 2 kids, and they're all under the age of 6. And that household qualifies to get $300 per month per child for those 2 kids. So that's additional $600 that's going to be coming in to this particular household. Let's say, for instance, if we take half of that $600 and we apply an additional $300 to this particular scenario. So that goes from $250 now to $550. Once we take root of this here, we go down here and we look. So instead of paying this off in August of 2022, this now is paid off in November 2021. So that's paid off this year. We go and look here. Now our debt is retired. Our total debt is retired in August of 2022. One other thing what this particular application does is in the event you get an additional payment. Let's say, for instance, you may get a bonus on your job. You may get a raise on your job. Let's say, for instance, we're in June now. So let's say in July, you may be getting a bonus from your particular job. And let's say, for instance, that bonus is $1,000 and you want to tack that bonus and put it towards your debt. How does that really look now once we play into this particular equation? So we take this July 2021. We want to save this here. Let me see here. So that's being saved. We're going to go back over here and we're going to see now that this $1,000 taking root here in July. And now instead of November, this is paid off in September. Instead of August 2022, this is now paid off in June 2022. If we go back here, let's say, for instance, you can go and add your income tax checks or whatever, always to your additional payments. Another thing what this does and how we capture this is looking at your overall credit utilization, which really helps your credit. So your overall credit utilization is important because this tells you your available credit that's available to you. And it tells you basically between this 100 to 0 scale, how much of it that you're using. So in this particular scenario, this person here is using about 71% of the credit that's available to them. When it comes to your credit score, this is a big factor in evaluating your overall score. The ideal situation that you want to be in is from 0 to 30 right here in green. The more you're here in green, the higher your credit score would be. So what we're also doing in this particular program is not only just capturing your debt, but we're looking at your overall credit utilization to help you to increase your credit score and to lower your overall credit utilization. By using these resources to pay down your debt, it's going to lower your overall credit utilization. And as a result, it's going to increase your credit score. So in the event you need to go buy a house, in the event you need to buy a car, this further helps align you with the additional resources that you're getting from the child tax credit. All right. So this is the debt portion of it. Now, the main piece and what we like to talk about is growing in our finances. And growing in our finances in the best way possible is planting a seed and not just putting it in a savings account and letting it grow a little bit, but being able to maximize it now through investing, whether it's through retirement, whether it's through real estate, whether it's through college, or whether it's through general purpose. One of the main things that we like to stress that investing does not take a lot of money. The earlier that you start, the more that you allow time and compound interest to grow. Now, I tell our members in our community, for the LESWIN financial community, that money has two best friends. And those two best friends is time and compound interest. The more time that you have, the more compound interest will work for you. And so we kind of want to show you some examples of basically how that looks. And I have an Excel spreadsheet that I've created today. And so we want to look at a scenario where we have a 6-year-old child. And we want to look at this and say, how will the child tax credit be able to benefit a 6-year-old child? So we use that same example we did in the debt management program, whereas if you have 2 kids in a household that's under the age of 6, and per child, they're going to get the parents will get $300. How do you impact the child's life based off some of these additional resources that's going to come in? Now, when we look at investing, there are several ways that you can invest in a child. There's through a 529 college savings plan, to where any money that you invest is specifically earmarked for college. Or you can just do some straight generational wealth building by just opening up a regular custodial account. And we like to teach parents and kids how to invest at whatever dollar amount you want, at whatever index fund, mutual fund, or stock that you would like to invest in. And typically we like teaching kids to own what you consume. What does kids like? Apple, because they are iPhones. They love Instagram. Facebook is for old people like us, so they don't like Facebook. But guess who owns Instagram? Facebook. They like wearing Jordans. It's part of the Nike brand, right? They like wearing Vans shoes. They love this new gaming system now called Roblox, where you're able to play these video games. And the main thing that we like Roblox is the fact that kids now is able to socialize. And so when you can build a community where you're actually playing games and then you can actually be social with other friends, Roblox is a great platform. You buy a Robux, instead of buying a Robux, you invest into Roblox. You look at the Xbox. Who owns Xbox? Microsoft. That's what we love teaching kids. So let's use this example here. So we have this 6-year-old student, and this 6-year-old, let's say for instance, we apply this towards a general custodial investment account. And let's say within the first 6 months we're getting this additional money. If the parents decides to put additional $200 or open this account up and put $200 per month out of the $600, let's say for instance, we take that $200 times 6, that's $1,200. If the parent doesn't do anything else, you take the $1,200, and if we focus on really getting a 10% annualized return, and you can invest in some of the strongest investments like an S&P 500, which is a very broad and diverse index fund, mutual fund. You take this $1,200 and you look at a 10% annualized return. By the time that this child here graduates high school, this now $1,200 is worth $4,100. But once we get the swing of this and we understand this a little bit more, and if a parent decides to say, you know what, if I treat this like a bill and I decide to put $100 a month into this child's account, that's now $1,200 for the year. And if you continue to do this in this scenario, now by the time that the child graduates here at 18, now you have $32,000. And of course, the more that you apply, it's even better. But as I mentioned, money has two best friends. That's time and that compound interest. If we use this 6-year-old, let's go and say, for instance, you have a 2-year-old child. The same principle, you can apply it. And now at the age of 18, if we adopt the same particular policy, instead of having $32,000, Now, this child here, when they graduate high school at 18, they can now have $53,000. That's why it's important. I do this with my 3 sons. From everyone when they was born, as soon as the Social Security number came in, we open up investment accounts because I understood and I knew as an investor that it's important to me that the time that they're born, in order for me to start planting the seeds in them, is the money is going to be able to grow. All right. So I want to show something else here with you here with Fidelity. Fidelity is a great way if you want to just start learning about investing. I know a lot of people divert over to Robinhood, but Robinhood is kind of like if you just start out beginning, but same way with Fidelity, but they offer so many more futures in itself. Let me just put a disclaimer out here. I'm not an affiliate or I don't work for Fidelity. But I've been an investor for a long time and use several different platforms in itself. But this is one, Fidelity is the largest investment brokerage firm. But let's talk about this here. When we start talking about saving and investing for a child, we mentioned the 529 college savings plan a little bit earlier, and that's specifically for college. Now Fidelity has a youth account available to teens 13 to 17. You have your custodial accounts, and you now have your Roth IRA for kids accounts. Your Roth IRA for kids is basically this right here is a kid. If they're working in high school, they're working in say middle school, this right here, any parent, grandparent, aunt or uncle can open up an account. But the key thing with a Roth IRA account is the child must have earned income. That they must have some type of qualifying job. What is a qualifying income for a kid? You can do from a job or self-employment, babysitting, mowing lawns, shoveling snow, whatever you want to do. Those type of things you're able to do with a Roth IRA for kids account. The earlier you start, the better it is. Now I want to show you this one last thing here, and then I will be done. So let's take, for instance, we have this year, 2021, a class of 2021, kids are graduating from high school. So let's take, for example, if we look back to 2003, and let's say, for instance, this is when this class of 2021 is the year that they were born. And then we take this on a year-by-year basis. And if we include this year, let's say, for instance, you as a parent, you take some of these resources. Let's say, for instance, you take $300 to open up an account. And again, if we treat this like a bill, and we put maybe instead of $150, we put this as $100 towards an account every month. What will this grow into? So instead of putting these individual stocks, what could be a little bit more riskier, I want to go here and I want to show you, matter of fact, let me just do this here. We want to show you basically an example of an index fund instead of single stocks. All right. So let's just change this up a little bit. I'm gonna do the same thing here. I'm gonna go back here, and this is gonna be pretty powerful. Let me go here. So we're gonna go 2003. All right, and then we're gonna take this here, 2021. We'll include this year. You open this account up with $250. Your cash flow. Let's say, for instance, you put $100 a month into this account. We're going to see at the point of time where when this kid here was born, you open this account up with $250. And every month from the time that a high school senior was born till today, how much will that actually be worth today? Now I'm going to pick a certain fund. I'm going to pick say, for instance, we're going to scroll up here and we're going to say the US stock market, which is generally an S&P 500 fund. Now, I keep saying S&P 500. I provided my contact information. If you guys want to know more about the different investments and how that work, well, it's short on time today. But let's say, for instance, we put that into the US stock market. We're going to see, starting out in this particular case here, let me go here. Here we go. So here's your $250 that you started out with. Putting $100 in there every month from a class of 2021 student. The final balance today now will be worth $93,781. Imagine a high school graduate walking across that stage with $93,000 and you start out with $250 and you put $100 a month into that particular account. Young ladies, and young men on this call today, you're spending $100 a month eating out. You're spending $100 a month shopping. And we plant the seed and we sow it into our future. This is what the results get. And this is actually real time. This actually shows us a chart and it's going in one direction. Yeah, you have dips, but over time, this chart goes up. And the real-time utilization tells you the annual returns dating back to when they were born here in 2003, all the way till today. And you will see that there's not too many years where this has been down. It's been down 2 years out of these 18 years that they've been living. And you look at this, it's been averaging 11.4% annualized since they have been born. Let's talk about this. A savings account don't even give us 1%. So when you actually use your dollars to work for you, this is the main principle that we want to share and teach with you with these additional resources that's coming in. Here's how you can actually put those to work in itself. So I want to conclude the presentation for any particular questions.
Okay, it looks like we don't have any questions. Participants, please feel free to type your questions in the chat. We would love to hear your questions answered.
Okay, well, it seems like we don't have any. Okay, yes, we do.
We
Go ahead,
do.
Ginger.
Yes,
Yeah,
we
go
do have
ahead.
a question. Okay, what investment particular is now paying 10% interest?
That's a very great question. You know what? I'm gonna share, Miss Collins. Let me just show you here. That's a very, very great question, and I'll just go ahead and share this here with you, and this won't take long. And when we look at this here, let me just go up here. I'm gonna go over here, and when I mentioned the S&P 500, let's just talk about this here. This one particular fund right here, guys. This is just amazing. This is 500 companies inside of one basket spread across 11 different industries. This one particular fund here, when we look at the S&P 500 and we look at the performance, there's a lot of numbers on here. I want you guys to focus on the performance. So far this year, this one fund right here is up 13% so far this year. All right. If you look over the last 10 years, this one fund right here has been averaging almost 14% per year. Now, what is this particular fund invested in? This is why we say, instead of trying to go find a needle in a haystack, you buy the whole haystack. Look at all these companies that it's invested in. So you have a total of 508 companies inside this one basket. And every single one of these companies here, we're all familiar with. These 10 companies here represents 26% of this particular S&P 500 fund. This here so far is up 13% today. Guess what? Guess how much it costs to buy this? At whatever dollar amount you want. If you want to put $10 towards this, you can put $10 towards it. If you want to put 20,000, 100,000, 300,000, whatever dollar amount, you're able to do that. That's a great question.
Okay, and to our presenters, very good presentations from one of the participants. Okay. Okay, looks like we have. Okay, yes, thank you all very much. Very good presentations. Thank you, excellent presentations. Okay, and participants, as you can see, Mr. Raleigh has provided his contact information in the chat. If you would take a look at that and just record that information for you. You can contact him at 954-393-7337, or you can contact him via www.leswinfinancial.com for more information if you have additional questions. Okay.
I'm sorry.
Any other-
I would just like to say that both presentations were great presentations, and I learned a lot of stuff for myself. So I hope that everyone that's on the call learned valuable information that they can use for themselves, so they can take back to help benefit their families. As Ginger said, information is from Mr. Riley is in the chat box, and we also have in the chat box, we all need you to complete the evaluation. That will help us help you, because if you give us feedback on how we did, it will help us plan for our future programs. We also have another survey, our technology survey. We would like for you all to fill that out as well, to give us feedback on information trainings that we may be offering in the future. And we also have a handout with newsletter with key factors of the child care tax. If you would like that, just let us know. We'll email it out to you. But just be sure to do the evaluations and the technology surveys. And that's all that I have. If any of my committee members would like to have anything to say or anything that I'm leaving out, just let me know.
Great job.
Thank you. We have a bunch of, in our chats, we have just comments from attendees from the programs. They're saying thank you so much, wonderful information that was needed. And I see that the child care tax credit key factors newsletter is in the chat box for you to download. And if there is nothing else, we can log off and leave at this time.
Thank you. Have a good one.